Master your emotions, master your risk smart.
All right, so before we go any further, I do want to address some of the ways that other retail traders identify the direction versus how we identify the direction. All right, so the reason why this is important is because I really want you guys to see and identify the way we do it, because the way we do it, and not to be biased, we think it's really good and it's very effective, that at best. Now, I'm gonna say this kind of quickly here, just so you guys can, so I can get the curiosity out of the bag. The way we identify direction is based off of liquidity. Now, I know some of you guys out there will be like, well, okay, it's liquidity. We've understood all these liquidity concepts, whatever, you know. No, let me just stop you there for a second. You haven't seen what I'm about to show you. Now, when I show it to you, you guys are gonna actually, when I show it to you, I'm gonna show you the theory and why it works, okay? The why is really important here, because a lot of people just show you, very mechanical ways of actually, identifying, say the direction based off of structure, based off of breakout retests or, trend lines or what have you, right? But that's not what we're gonna teach you here today. So quickly, I'm gonna go show you guys right now on my screen. So come down on my screen, I'm gonna show you guys how they see it versus how we see it, okay? So here we go. All right, so a lot of the traders, right, just to kind of get the cat out of the bag and get everything out of the way, a lot of people see it based off of, retail scenarios, right? So say, for example, if we have a bullish example, right, you got the breakout traders, right? Essentially, when price breaks out, right, people are chasing the market, right? They're trying to get into the momentum. Say the momentum started this low, right? Prices are rising, so why not get in, right? Why not buy and catch a few pips or whatever, right? So that's one way, right? The other way, obviously, as we know, is the trend. Now the trend doesn't really, the trend line or whatever, it works, but it doesn't work, right? And the reason why this doesn't effectively work, because we all know that this is creating liquidity in the market. So we definitely want to be paying attention to this, that this doesn't really, it's not as effective, right? Other ways, obviously, people are doing it is based off supply and demand. Now, supply and demand, hear me out here, is not inherently wrong. It is not wrong. However, it works sometimes in and around this method because there's liquidity internal between the low and the high. So say, for example, when price gets to a demand zone like this, right? I used to trade supply and demand, right? When price gets to the demand zone, right, we look for buying pressure right at this low because price is respecting this demand. You would then look for your confirmation in here, right, in this leg over here before the leg pushes impulsively, right? So it's not inherently wrong, but it's not entirely true either at the same time. Now, the only reason why this would work is because there is liquidity inside, right? There's either an inducement that drops in like this, right? Then price comes back in, sweeps the inducement, then runs. That is very effective, right? Other ways you can see it is when there's a bunch of, say, trend line liquidity, whatever, it's, something like that, right? Liquidity, price comes in and runs, right? So supply and demand is another way, right? There's obviously, like we mentioned, the break and retest traders, right? So when price breaks, right, price comes in, excuse me, that's horrible. When price breaks, something like that, right? Price comes into the retest area, right? Or the, what is it? There's this resistance and support, right? So this would be support and resistance, right? So this would be support level, yeah, right? So people are trying to buy here, right? Then price goes against them, or it could run depending on whether there's liquidity internally, right? So all these strategies in terms of finding the direction can be effective. However, we always need to keep in mind where the liquidity is, right? Now they're not all inherently wrong, but they're all not inherently true either to some extent. So in our eyes, we identify the liquidity. Now, liquidity concepts are a dime a dozen. You can identify them based on trend lines. You can identify them based on, swing low, swing highs. You can find them based on inducements. You can find liquidity on relative lows, relative highs, double tops, double bottoms, triple tops, triple bottoms, right? You can go on and on and on. However, what I'm about to show you guys right now is dangerously effective. Come to my screen right now, and we're going to show you guys right now how and why our concept works so effectively. So why does this method work? So the reason why this works so well is because if you guys understand anything about liquidity, is that price moves liquidity, right? We need to understand, whenever liquidity is swept, price pushes the other way, right? So in this case, you can see right over here, let's even just exaggerate this a bit. Okay, like this. All right, let's just say this is a swing low, right? Price sweeps the low. What does it do? We know every swing low and swing high is liquidity. Swing low, swing highs, they're also a form of inducement, right? If you don't see trendline liquidity, double tops, double bottoms, then most likely that single low that is right here, you know, say for example, like right here, a single low, right? That's placed right there, is a form of liquidity, right? So we want to be able to make sure we identify the swing lows, swing highs, because everything that you see in the market is liquidity. And when you see it, we trade away from liquidity, right? That's what we do. We trade away from liquidity. Now, it's important to be at the higher time frames, obviously, like the daily, the weekly, 4 hour, because there's more weight holding on the higher time frame than there is the lower time frame. A lot of people love to trade the lower time frames. I used to do that too, and I still do in some cases based off, you know, when I'm scalping. However, I will show you right now why this method works and talk to you about the theory why it works. Now we know this to be true, that liquidity actually moves the market. So if it's liquidity, right, in the form of inducements, let's say, or in the form of, you know, relative highs, something like this, right? This was supposed to be something like that, right? Something like that, right? We know price moves. And so what do? We trade away from the liquidity. Now, let's just say this whole example here is the daily time frame. Let's go right here quickly. Where is it? I can't find it. Right here. Let's just say this whole area here is the daily time frame. Okay? Let's put a D for daily time frame. D right there, okay? Yep. There we go. Okay, and let's just say this whole area, everything you see is daily. Now, what's cool about this, okay, and let's talk about the sessions, okay? So whenever price sweeps liquidity, let's go here from this example right here. Whenever price sweeps the lows, this will be the inducement. Okay, on the daily, what we're anticipating right here is for price to reverse. Now, because there's a lot of traders that took a buy in this area, right? In this low, a lot of traders took a buy here, right? Price sweeps them, right? So what happens down here on the daily, right? We are anticipating that price would reverse. Now, the reason why we anticipate the price to reverse, because again, it swept liquidity. Now, internally, when your sessions come, okay, when they come, let's just say you trade the London session or the New York session, right? What you want to anticipate here is London and New York will most likely, a lot of times, 90% of the time, 99% of the time, are going to run bullish. They're going to go bullish here because it has swept the daily low or the daily high, okay? So whenever the daily low is swept like this, we're going to anticipate, which means the daily, or excuse me, which means that the London session is going to run bullish, right? And then following London is going to be New York, right? That's why there's a saying out there, you know, when London runs, right, it normally, New York follows right after, right? So we want to be following, if you're trading New York, right, you want to see where London is, and if it's running in the same direction, New York most of the time, and usually it follows London, right? So we're going to anticipate that all the markets, you know, in those sessions, that the markets are going to go bullish, right? And usually in this leg, right, when it sweeps the daily low, in this case, the daily low, it'll give you, you know, maybe a week's worth of data here, right? Like you're gonna be set for the whole entire week normally, right? Because each session is what, about 8 hours, right? It's 8 hours per day, right? So it can take you about a whole entire week for price to run bullish. And now you have your direction set, right? You have your direction set for the entire week. So now you don't have to be bothered about, oh, which direction am I going to be trading in today, you know, or today or the tomorrow or whatever. You're going to know specifically which direction price is going to go. Now, just remember this, okay? I want to say this. Because each session runs 8 hours a day, we want to know and we want to see data that is bigger than what the everyday session is, right? So say, for example, if the market runs 8 hours a day, we want to be larger. We want to go on the higher time frames and to identify that direction, because and find out that direction, or find out where the liquidity is on the larger time frames, because we know good and well that the markets are going to run for an entire few days for an entire week, right? So once price runs, right, comes back down, right? So on days, like see this, for example, when price runs here, right, right, we are looking for sells, obviously. So this could take a couple of days, you know, for prices to run bearish, right? So we know when prices take out a high, price will go bearish, right? You're not going to try and hold the entire, say, for example, you're not going to try and hold the entire impulse going bearish like this. No. What this means is you're going to catch the session impulse of the day. That could be, say, for example, London in here, right? And that could be New York here. Right? So this could be one entire day, right? So we know that when prices are going bearish, it's because we just swept the high here and we're utilizing the liquidity and using the momentum of that liquidity, right, to continue pushing bearish. So now we're with the trend, right? So say, for example, here, this low reacted to something. We don't know what it is, right? The price runs. And then this is the next day, right? Should we be trading, right? Should we be trading between this low and before this high breaks? No, because there is no liquidity swept, right? But once price breaks this high, right, and then now we are in the next day here, right, and then maybe London opens, or maybe London pushes price up like this, right, and then New York starts right over here. That means once price has swept that high, New York is going to follow price bearish, right, because it just swept liquidity. So now we know New York is going to follow bearish just like that. Right, and now price continues. Now on the next day, right, price breaks the low, right, sweeps the low, right, that's a swing low or whatever, right. Then now when price gets to here, right, now we know this is London. If London's around here at the time, right, we can look for London to go run bullish. So we can look for chalk boss, right, go to your lower time frames in here to look for your chalk boss to rise higher, because that's where London opened, right. And then when London opened here, excuse me, that one's gone here. When London opened, right, we can follow New York right after. So New York might be right after, say, for example, you know, here, right? So this could be London right here, right over here, right, something like that. Let's put it to red box maybe. All right, so this could be London, and then this would have been New York, right? So you've had both of your directions set bullish, because that's what price did right here. It swept the liquidity on the daily low, right? All right, so I hope you guys understand this concept, right? Now I'm going to show you guys on a real time frame, on a real chart example, so you guys can see what I'm talking about. So let's go on GBP USD. It can be anything really, and I will show you how this works. Let me just take this off. Okay, let me just do this. And let me run this down a bit so I can get the replay button here. All right, and let's do that. Let's do this. Okay, so the important part of this is really to identify your highs and lows. Wherever there's a high, there's a low, or triple tops, triple bottoms, any form of liquidity, guys, you need to be marking them out, because it's liquidity at the end of the day, and then you trade away from it. So let's go on a 30-minute, right? Let's go even on a 15-minute. So I'm going to toggle on my sessions right here quickly, and you guys will see what is happening. So right here you can see that New York went up, right? We're above the liquidity line here. This is the daily, right? What we want to be anticipating is, because price swept the high, we want to go here on this on the sessions, on the current session, right? Which would be, let's say, London and or New York. So London's right here, right? You can see London was going bearish at the day. Sure enough, there is some consolidation going on here because of whatever, right? Again, you can see here New York is also going bearish in some points in time, but we're anticipating what you want to do here is anticipate for prices to run bearish here, because this is where the session should be running. Okay, let me go this way. Let's go here. All right, let's continue. Let's continue here. Let me just play it out kind of quickly. Play it out right here. Okay, notice what's happening, guys, right? So notice what's happening. Because we want price to come back because of the liquidity sweeps, right? Prices are trying to come bearish, right? That's what we're trying to do here. Now you can see in this leg here, you can see how there's London, right? We skipped the Asia. There's London in green, and there's New York in red, right? So prices did go bearish that day, right? So we can continue, right? There's London again, and there is New York again right there. So at minimum, I want to hit, say, this low, right? At least this demand zone right here, right? Just something like that. Let's see if we can do that. All right, there's London again, and there's New York, just like that, right? So again, let me just iterate what happened here, right? When price ran up, right? When London opens, New York opens, you want to be trading down, right? Because we just swept liquidity, right? In these concepts, you can see here, let's even drag your attention right over here. In this concept right here, when London opened over here, right, it did sweep some liquidity, raised, right? So this is where we would be looking to strike, right? And this is the 15-minute, obviously. We would drag our attention down to the 1 minute right here on the 1 minute and pretty much look for entries right here and then target, say, this low, you know, this low, right? Depending on how fast the market is moving. Now, in these areas, there must have been some holidays because price doesn't really run. It's not running that much, right? In this case, price London is moving high right over here, right? Oops. Okay, London's moving high, right? But what we're anticipating here is we want London to switch bearish, right? We don't want it to go bullish because this is a bearish market. This is a bearish sentiment, right? And here you can see prices are going bullish, right? It's trying to trick you, right? So then prices are going bearish here. You can see that London has switched. It is selling off. Also, New York swept here, sold off, right? So this could have been 2 wins for the day. This could have been another win. This might have been a win or a loss or a break even, depending on how you see this, right? And then London comes back in again, right? Now, obviously, I wouldn't be trading New York on GBP because it's not a New York, the currency's not on New York, although it does have USD. I would probably trade, say, NASDAQ or the Dow Jones for New York specifically. But if you look at London, right, it is impulsively bearish. So London sweeps the highs, right, comes in here, sweeps the liquidity, runs down here, and it TPs down here, right? So something like this, right? So there you go. That's an example on the daily. Let's do another example. Let's go find out more daily highs and daily lows. So here is another daily high, right? Now, there's other ways to do it, obviously, to look on the 4-hour high or 4-hour lows in order to take advantage of this. But let's take a look at here. We just swept here, and let's go to the 15-minute here. Now, during this time, right now, it's very important that you know that you need to be trading during your session, not randomly in the Asia or the Australian, right? So you can see how here, let's play this kind of quickly. You can see how here, you can see how here, New York, right, price came down to this low, and you can start looking for buys because New York is opening up, right? New York opened up here, it took out this low, right? And more importantly, it took out this main low, right? So what we can do is start anticipating to look for bullish examples, right? Here's a sweep of liquidity right there. You could have held that, right, and made some made some profit right there, right? If you were trading Asia, you could do the same thing on Asia, right over here. We swept some liquidity, Asia rose up, right? Just like that. And now Asia swept London highs, you can see there. Price went bearish, right? Let's go on the daily again so we can show you again how this works. So let's just wait for, okay, right there. We can also look at this high right there. Okay, all right, so I went a bit too fast there, but let's go down on the 15-minute. All right, so we had price run up here, right, on the high. This one was taken out. You can see how price took out this high over here to the left. You see New York went bearish, right? And then Asia started here. Again, price took out this high, which took out the New York high, London. So we can start looking for bearish momentum, right? What I wanted to say here is once price broke this daily high, right, we would anticipate for price to go bearish. So in your lower time frame, you're going to look for sells. Look how price is moving bearish, right? It came down here, hit this, retest it level or whatever, and then, right, that would be, you would be done there for the day, right? Now, it wouldn't be done for the day, obviously, because you'd have an entire week for prices to continue bearish. Now you've known and you recognize and you see that the direction is bearish the whole entire week. It's not bullish at all, right? I mean, there are some bullish moves in there, say for example here, but that's because we took out another low, so this is only a retracement, right? So when price took out this low, this liquidity, price is moving this way, and we would be trading after price took that low out, right? You'd be looking for your London open, right? We're not going to trade the Asia. Right over here, you can see price, London opened up right over here, price run over, right, swept this low, I believe. Did it sweep this low? No, it didn't, but it did something in here on the demand perspective, and then price started shooting up. Same thing with this, right? New York followed right after, right? So that's how you would use this concept. Now let's continue here and go and sweep another daily low. right? Right over here. All right, so we can do that. Let's wait for price to sweep. There we go. Now let's go down on the 15-minute because we're going to be expecting for prices to run bullish, right? You know, it's going to take a while. Let's go on the 4-hour actually. Let's create that impulse. There we go, right? Notice how price ran up, right? Now let's go on the 15, right over here. So what would you have here? You would have about 2 days worth of, no, about 3 days. So 1, 2, 3, right? So you have 3 days to look for prices to run bullish, right? And depending on your session, right? If this was the London here, you'd be looking for buys. So there's a buying opportunity here. I can see that, right? New York would have opened here, but I would still look for price to run up, right? This would be another low that I need to sweep. And then here, when price sweeps this low, so I wouldn't be able to trade. New York because New York is here, right? And we want to wait for a low to be swept for price to run. So once we get here, you can see it's already 12:45. That means New York ends unless this is Los Angeles time. So that means we have about an hour and a half, 2 hours accounted for before price ends, right? And so that's it. Then we wait for the next day. You can see that we're still waiting for price to go bullish. Price swept, right? London swept. Now you can look for prices to come in here, right? Sweeps the liquidity, run. You buy pretty much here to run bullish, right? Same thing with New York. Price drops, right? It doesn't really sweep anything here. You might find something internally. New York runs bullish. All right, we're up here at this point in time. Price comes. So there's nothing up here that I'd be trading because there's no liquidity that was swept. It's mitigating supply, yes, but it's not sweeping anything. Price runs here, the low, right on New York. We could look for some buying pressure right here because it did sweep, so we can look for chalk boss to run bullish, right? So I hope you guys understand this concept that it is very effective and it's very nice. This is how I trade. This is how a lot of my team trades. If you guys like it, go ahead and throw a thumbs up on this video. Subscribe to this channel because we always get out free content, guys. Until then, we'll see you later.